Hello everyone, hope you guys are doing well today. Today we are going to be basically focusing on a topic that is known as process costing. And what is process costing? What is the main discussion in process costing? What is the fuss about? We are going to discuss it in detail. Now, first of all, process costing is a type of costing in which we look at a product that is homogeneous in nature. That means basically the products that are being there produced in the organization don't have any specific difference here. Okay. Now all the goods that are produced in the organization will be sold at the exact same price. Or even if you can say if one type of a product that has been produced in multiple processes will be sold at a similar price. Let's say if you take an example of Coke or Pepsi. Coke or Pepsi is a soft drink. A 250 ml bottle of Coke or Pepsi is going to be sold at the same price. I cannot go and pick one bottle of 250 ml of Coke and say that I will pay 10 rupees lower than normal price for this particular product. So all of them are identical in nature. They don't have any difference that can be identified in the particular product. Okay. Now, in process costing, what is happening? The particular product that we are producing is in multiple stages. Now, let's just take an example, just a random example. If I am picking up a denim jeans, okay. Now, if I pick a denim jeans, there are mainly three types of processes involved. So, if I identify the process that commonly everyone can relate to is cutting, then this is stitching, and the next one is finishing. Okay. Now, if we are making one type of product, if you're making only one type of product and we're producing 1000 units for that particular product. Now, there might be a situation that out of 1000, 300 might be in process of cutting, 400 might be in stitching, and 300 might be in the finishing stage, right? Now, in process costing, the main thing that we have to identify is the cost per process. Now, if you're cutting 300 units, what was the total cost incurred in the cutting of the particular goods? Now, if we are able to identify the cost of cutting for all the goods incurred, we can easily, reasonably apply them or divide them on average basis on each the number of units that are produced. Let's say if the cutting of 300 units costed us 3000 rupees. I'm just taking random figures right now. I'm not intending to keep any kind of complex numbers here, just trying to give you numerical examples, theoretical concepts, and theoretical knowledge so that you are able to understand what is the concept of process costing. Stitching took us 2000, finishing took us 1200. Okay. And what we can do is we will be able to identify cost per unit if we just divide all of these by the number of units produced. Now, the cost of the total process divided by number of units produced in that particular process. So we'll get the cost per unit for the complete process that was initially done. So if 3000 divided by 300 gives me 10. Then we have 2000 divided by 400. So 5 per unit. 1200 divided by 300 gives me 4 per unit. Okay, so the cost of the process of producing one unit in cutting is 10 rupees, stitching is 5 rupees, and finishing is 4 rupees. Now, all of these are just imaginary numbers, no relation with practicality right now, just a concept I'm trying to establish here. Now, at the end of the day, when we are looking at the process being completed, one good coming out of the finish department, the finished good will have a total cost of 10 plus 5 plus 4. That equals to 90. That basically is giving us the idea of what it is telling us that the complete cost incurred in the particular procedure, the complete cost that incurred in the particular procedure is approximately 19 rupees. and we have to pay that amount, or we will valuing our inventory based on this amount. Okay. Now this amount basically represents the value of inventory. Okay. Now if we are able to cost the particular goods in each process, what is the benefit of that? Now the benefit here is, commonly we can see, or everyone knows one thing, one concept very easily, very obviously, that in each process, if we are having some goods that are rejected in nature, we are having any goods that are rejected in nature, we can identify them as well. So if we are costing for the particular process, we are checking the goods that came in and went out as well, right? So if in each process we are identifying the goods that came in and the goods that are further given to other processes to process, how many are those? If we are following this process, if we are following this process, then what can be there? Now, here what can be done is, we can see reasonably see that a good that went from cutting to finishing took 19 rupees. Now, if you gave the input of, let's say, 300 units in cutting department, there we found that 10 units or 20 units were defected in the process of cutting. Now, if 20 units were defected in the process of cutting, the cost equals to 20 into 10, 200 rupees. Now we have wasted 200 rupees worth of cost. Now, what the idea here is that if we are able to detect them on process 1 of cutting, then we will not further let it go towards the processing. So additionally, the cost of 5 per unit and 4 per unit will be saved here. That means in terms of the total cost saved, 20 units into 9 makes it 180 rupees. So we are saving 180 additional rupees that could have been wasted if we would have not identified the defective units in the cutting stage. So if they are identified in the cutting stage, we will remove them from the cutting stage and we will sell it off towards the scrap, or we will just waste them out. So process costing helps us identify defective goods, reduce cost. Allocation of cost towards a particular product is more easier, more flexible, and more accurate in nature. Okay. Now just let's read the wording of the examiner so that we are able to just reflect on the examination as well. So process costing is usually organizations that process that produces large volume identical similar inputs as an output, and in a continuous process. So there will be situations where the goods that are manufactured in the organization, some of them will be at the air end at different stages here. Okay. So each should be able to be valued at the amount of input that has been allocated towards the product. Okay. So in this environment, individual units cannot be separately identified. Cost accumulated by process and the cost allocated to the products or units by averaging out. The basic formula of process costing is total process cost divided by number of units produced. Okay. Now, we have basically established earlier on as well that when we are having goods that are under process or under manufacturing are commonly allocated in the department of work in progress department. Okay. So at any point, some units may be not fully completed and still undergoing process. So incomplete goods that are known as work in progress goods can be valued accurately through process costing valuation. Okay. Now let's see the T account. The T account is extremely easy here. How is it easy? I'll just give you a hint of it. Now look, first of all, the process account has debit and credit side. Consider it as an asset account. Okay. Whenever goods are coming in, whenever something or any cost or any goods are coming in, anything that is added to the particular process, let's say labor, expenses, any kind of cost that is incurred on the product is posted on the debit side. And when the good is completed or defected or there's a loss, then we transfer it out to the other departments, whether it be the scrap, the warehouse, any other area. So the cost and the units that when are moved out of the work in progress department from the production department is posted on the credit side here. Okay. So debit side brings in all the cost and credit side removes all the cost, all the units from the organization. Okay. Now, one thing that I want to convey you before we move on towards the next area is stages of costing in process account, on process costing. Now, normally what we see in organizations is we have three stages. Number one is planning. Second is execution. And third is evaluation. Okay. Now, in planning phase, we are deciding what to do, how to do, what should be the things done here, how should we basically be identifying things, etc. etc. Now, remember one thing, what is the objective of internal costing? First of all, to evaluate your performance and position. Evaluation, but is done at the end of the year. Evaluation, as I have written, is done at the end of the year. So if you're doing evaluation, that is not the only purpose of process costing or any kind of costing method. The main idea or the main concept of planning or basically identifying multiple methods through which we can allocate cost or process cost or basically derive the cost of the particular product is to set a selling price. The main goal here is to identify a selling price that is accurate in nature. So that can only be done at the planning stage. Why it can be done on the planning stage? Now look, think logically. If you're going to a particular shop and you are buying something that is common, let's say Pepsi. If you're buying Pepsi and you are buying it from organization, you go into a store and they say that the price is not yet discussed. We will let you know when the price is discussed or decided upon. No, they will not do it. Obviously, the price is to be decided before the goods are being sold to the normal consumers. So all the plannings regarding the losses, regarding any overheads, any other cost that should be incurred, should be basically allocated to the particular good beforehand, planned before it. So the selling price is determined at the planning phase. Okay. At the execution phase, we are trying to fulfill the targets that we have set for ourselves. And in the evaluation phase, we basically do what? We compare budgets or estimates versus actual. Now remember these stages because the next thing that we're going to study is going to basically help us in determining or checking these things. Okay, next thing I'm going to tell you is going to directly be linked here. Now, when an organization produces goods, they have to anticipate for all possible outcomes, right? And in the organization that I've obviously discussed it with you, that there are losses, there are wastages, there are defects at each stage, right? So when an organization is identifying a cost of a particular unit, what is the formula for that? The formula for that is total cost divided by number of units that are produced, right? This is the formula for per unit cost or the cost of one process per unit. Now think logically, if there's a defect, what will we do then? Now there are multiple things that we can do or multiple things that we have to think about it. Now, in this particular situation, process costing has two types of defects or two types of losses. Number one is normal loss and number two is abnormal loss. Okay, what is normal loss and what is abnormal loss? Normal loss is a loss that we have predicted beforehand. We have estimated it beforehand based on previous data that we have. So I can say that I'm writing this down for you that normal loss is an estimate of lost units. Okay. So what is normal loss? Normal loss is an estimate of lost units. That means basically when we are producing goods, I gave an input to a machine for 1,000 units. Now, based on my commercial acumen, based on my previous experiences, I can estimate that there will be some kind of loss. Now, how much loss will there be? So the loss is basically in every organization, every industry, every firm, the loss is different. But I'm assuming, let's say we assume that 5% of loss will be there. So of 1,005% is 50 units. So out of 1,000 units, 50 units are going to be defective in nature. Now, is this certain that 50 units are going to be there? No, it is not certain. We are assuming this, we are estimating this, we are predicting this, and this might happen. Okay. Now, If we are going to have a defective process or defective units of 50, we are having 50 units that are defective, it is going to be a loss for us. Yes, it is going to be a loss for us. So what should we do now? So here at this stage, businesses take decisions. What decisions are those? Decisions are that this loss should be covered up. Now we are at which stage? We are at the planning stage. We are at the planning stage. So again, I'm adding some additional data that normal loss is identified at planning stage or estimated at planning stage. Why? We are going to do this at the planning stage for a specific reason. Now, why do we basically go for this in the planning phase? That is the question. Now, the specific reason for going into the planning phase of the particular processing and identifying normal loss is so that we can recover the loss that is happening within us. In the organization, if there is a loss, and we can anticipate that, we can estimate that. So won't you recover it? Yes, we would. Obviously, we would. So here in this phase, we would try our best to recover the loss that we are having. So in the planning phase, what do we do is once we identify the normal loss, we try to recover the loss from the units that are sellable in nature. So how can we do that? That's in a little simple process. Now, what do we do here is now what we do normally is that let's say if we have 1,000 units and we say that 5% of them are not going to be in a position to be sold. That means 50 units are defective, right? So if 50 units are defective in nature, that means basically we are going to have a position where the particular goods that are sellable in nature are our prime focus, right? So if they are our prime focus, the goods that are in a sellable condition, how many are those? Those would be 1,000 minus 50, that is 950. So these goods can be sold in the market. So shouldn't we try to recover the cost that is identified in the process and allocate the price on the goods that we can sell? We should. So let's say if the particular cost of the process was 10,000, this was total cost. So if there was no normal loss, the particular unit cost would have been 10. But because here is a normal loss and we want to recover it, we will do this. 10,000 divided by 950 only. If you're dividing it by 950, what will happen? The overall cost per unit will reduce. And it will reduce by how much? That's what you have to see. It will reduce by, or it will not reduce, it will increase by a small portion. So instead of the price being 10, the price will be 10.5. So you see that the goods, the 50 units that we had, were the units that we were not able to sell. So the loss of those units are going to be recovered from the goods that we are going to be able to be sold in the market. Okay, that is normal loss for you and absorption normal loss per unit. Now, this is done in the planning phase because we are trying to identify the goods cost so that we can find an adequate selling price and recover the loss that we anticipate there to be. Okay, so this is how a normal loss works. Now there is one more variation here. The variation says that the goods that were damaged, can they be sold in the open market for any scrap value? Now that is a good question. Now here the scrap value is a value that is sold for defective goods, the wastage value, salvage value, any value that is normally lower than the normal price and but is present so that we can recover some amount from the loss that we have had. So let's say these 50 units were our loss and we say the scrap value is 5 per unit. That makes it 250. Now, out of the loss that we had, out of the loss that we are having, we can recover 250 rupees. So if we are able to recover 250 rupees from the wasted units, should we not reduce the particular cost of the process by the particular amount that we can retrieve from the defective units, so that the burden of those defective units do not go more on the particular correct units. How can we do that? We can do this by subtracting the cost by salvage value and dividing them by the expected number of units. So here in this situation, if 10,000 was the cost and salvage value of 50 units was 250 and the expected units were 950, the unit cost here is going to be 10.26. So you see, if there is a salvage value for a particular good, if there is salvage value available for a good that is damaged, then it will reduce the burden of the cost on the goods that are being able to be sold in the market. So it will represent a higher profitability for the goods and will basically show us a position where the goods are sold in a normal range. So let's just quickly go through the wordings of it. So here we can see that normal loss, is it expected? Yes, it is. So does it have any value? It has any value if there is a scrap value for it. And the accounting treatment will be, it will be not costed. That means the 50 units that were at a loss, those units are not going to be what? Having a particular cost at the end of the day. They are having a zero cost because the cost of those units are transferred to other units. Now, moving to next towards the abnormal loss and abnormal gain, abnormal part. Now, abnormal loss is a loss that comes in the organization or comes towards the organization when we are at the end of the process or when we are able to identify what has actually happened. So, abnormal loss, if I keep it put it in words, abnormal loss or gain, both of them can happen, or abnormal gain is a situation that occurs when actual results are presented. What do we mean by that? Now, in this situation, what did we have? We had that the input was 1000 units. We estimated a normal loss of 50 units here. That means we estimated our selling price or allocated the cost per unit based on 950 units. We estimated that we will have 50 units as a loss and 950 units are going to be correct. Now, this is estimate. Now, in actual, there can be a position where we are having 980 units, or there can be a situation we have 900 units. Yes, anything is possible. Now, because the normal loss was an estimate, it can be changed, it can be wrong, it can be fluctuating. So the actual position, if it is better than estimate, that means basically if we thought we will produce 950 units, but we made 980 units, there is a abnormal or unexpected gain of 30 units. And if the position is in a worse off position, that means if we expected 950 units, but we produced 900 units only, that means we are having an abnormal loss of 50 units. Now, this is the important stage. When do we realize this, or when do we get to know about this? This is understood, or this is checked when we are comparing our estimates with the actual position. And when do we do that? We do that in the evaluation phase. That means when everything has happened. And everything has happened, every product is in the finalization stage, every product is out of the air, at the air, and we check that what was the actual position and what was the budget that we had. So at this stage, can we recover the losses by adjusting the selling price? No, we cannot. We cannot do that because the selling price is already determined. The goods are in the selling positions. We cannot change the selling price now. So what do we have to do here? We have to bear the losses or take advantage of the gain and pay it out of our pocket or take it as an advantage as a whole. Okay, so abnormal losses are allocated the complete unit cost. So what was the unit cost? The unit cost was 19 rupees. So the loss, if we are having of 50 units, it will be multiplied by 19. That was 50 into 19. Now the complete cost of the particular $950 is going to be charged as an expense to your income statement. So I believe the concept of abnormal loss, which stage does it occur, normal loss is clear to you guys. We'll just read the wordings here. We'll see the tables here and see some examples as well so that we can relate to the examination questions better. So abnormal loss, is it expected? No, it is not. What is the value? The full cost, because we cannot recover the cost at any stage. We can only go for the salvage value, but it is not a thing that we can estimate or basically identify earlier on. And it is charged to P&L, so that basically where we are having a loss or benefit that is recorded in the income statement and the profit and losses are equally identified. Now, normal losses are unavoidable losses. It could be evaporation, chemical reactions, spillage, wastage of cutting, etc., etc. So if you boil water, some kind of particles evaporate, right? So in that stage, wastage is going to be there. So similar wastages are there in other areas as well. Now, for accounting purposes, we can see that normal losses have no cost on them. They are credited to the process account. We have seen that remaining good units that are sellable in nature or good units or complete units can be basically having the selling price allocated to them. So if I just quickly solve this numerically in front of you guys, the input units were 1000, 10% of them were lost. So first of all, expected units. Expected units are 1000 minus 10%, that is the loss. So 10% is equals to 10 units or 100 units, sorry. So my expected units are going to be 900 units. That means I am going to have a loss of 100 units and 900 units are going to be sold in open market. Okay. Now the scrap value is 2 per unit. That means the scrap value is equals to 100 into 2. The total scrap that I am achieving is 200 here. What was the formula of allocation of the unit cost? Was unit cost is equals to total cost, that is 18,000 stated in the question, minus any scrap value, that is 200, divided by expected units, that is 900. Unit cost here will be 19.78. Okay. Now, if you want to see the presentation of your particular process account, it will be as follows. Process account will show a debit side where cost is collected, that is 18,000. Next, we are having 200 worth of salvage value cost and 900 good units that are there in finished goods nature. Remember the number of units that were as an input and the number of units that are going as an output, whether be it normal loss and normal loss, whatever it is, it should be presented there and should be balanced out. Now, if I look at the double entries here, double entries are shown as follows: that normal loss account will be debited by 200, process account will be credited by 200. So if I see this, the account for normal loss will look like somewhat this. So normal loss account on the particular account, what we can see is normal loss is debited by 200 because this is the loss that we have incurred. So by the name of process, we are going to record 200 on the debit side. Now, what are we getting? Why is 200 allocated to the particular scrap value units or normal loss units? The 200 is allocated because this is the scrap value of those goods. So if the scrap value is identified, we can sell those goods and we can receive the money. Once we can receive the money, what can be there? The scrap value is basically the particular value that can be retrieved from the particular goods. So it will lower the overall cost of the units that are good in nature. So this is how we are going to record the particular double entry and the T account. Moving forward to abnormal losses, we have discussed the concepts, so quickly going through the wordings only. So abnormal loss is beyond expected normal loss. It can be machine breakages, poor supervision, accident, etc., etc. Accounting treatment of abnormal loss is valued at production cost per unit, transferred to abnormal loss account, and ultimately charged to profit and loss account. So at the end of the day, this loss is to be paid by you, by the company only, and there is no option to basically retrieve the cost back by open market. So now in this particular example, what is happening that we had expected units of 900 and actual units came out to be 850. So we had a loss more than expectation of 50 units. Now these 50 units are substantial. These are abnormal losses. We cannot retrieve the expenses for them. Now what can be done here? What can be done here is the 19.78 cost that was basically allocated for the good units for 900 units. The units will be having the same full cost. So 19.78 into 50, that means $988 worth of loss is to be borne by the company because they had additional spillage or wastages in the organization. So due to the additional wastages, we are going to have an account that is opened up for abnormal losses, and we have to bear that as well. Okay, so the normal loss account on the abnormal loss account is present in front of you as well, and the process account is in front of you as well. Where you can see that debit and the credit side is always balanced out by the number of units as well. So here, abnormal loss 150, and we had approximately 850 good units, and 1000 was an input here. In the abnormal loss account, we have to charge an expense. We have to charge or record an expense that will be borne by the company or bared by the company because this is the loss that we have not expected. So in this situation, the process account will show a credit entry, and on the abnormal loss account, we will show a debit entry, and the loss will be transferred to the income statement as it is an expense that we have to bear. It will reduce the profit of the organization. So whenever a profit is reduced, we have a debit side entry of P&L account. So you can see abnormal loss account debit, process account credit, and profit and loss account debit, and abnormal loss account credit. So in the income statement, we are charging a loss that we are going to basically have to face in the future. Now the scrap value account, the scrap value is similarly same concept, same thing that we can easily see. The only thing that you need to know here is that scrap from abnormal loss is credited to abnormal loss account, not the process account. Any scrap value coming in from the abnormal loss is credited to the particular abnormal loss account or transferred to the income statement because it has no benefit of us for us to basically put it in the process account because it is not going to lower any kind of cost for us. It is a loss that we have to bear. This abnormal loss salvage value is a benefit for the company that they don't basically expect. So this account is or this amount is directly transferred to the income statement so that we can benefit from it. Now, moving forward to abnormal gain. Abnormal gain is a little different dilemma here. Now, in abnormal gain, it occurs when actual loss is less than expected normal loss. It improves because, or it is coming in because we have good efficiency, we have better material or skilled labor. So we have seen that I have shown you example where we had 900 units expected output, but actual output came to be 930 units. That means 30 units were in excess of what we expected it to be. So if we have 30 more units than we expected it to be, this is a surprise for us. If this is a surprise for us, now what will we do? We will basically benefit from it. We'll benefit from it. How we will basically sell these goods in the open market for the complete value that they hold for, that is $19.78, right? So the account will look like this, where the abnormal gain will be posted on the debit side of your particular process account because this is the additional benefit. This is the additional benefit. These goods are basically additional to us, we can say that. And these are the goods that are going to be sold in the market for an additional price. So abnormal gain will be debited on the debit side, having the complete transactions. Abnormal gain account will show a credit entry of 593 showing that we are able to sell or we are having an additional $593 as a unit, And the scrap value for earlier unit, the scrap value is coming to be 30 into 2 units. These are the units that are basically retrieved as a normal gain. They were expected to have a normal loss, but these goods are having a particular gain. So this gain is recorded on the debit side, and the particular profit and loss account will have 533 as other income, as this is a basic advantage for the organization. So the double entries are as follows. Process account debit 593, normal loss account credit 593. A normal gain will be debit with normal loss account credit on 60. A normal gain account will have a debit balance of 533 that will be transferred to the income statement, credited to the income statement, so that it shows a other income for us. Okay. So this is how we record double entries for normal gain and normal loss. This is the comprehensive concept of the particular area, or particular concept of process costing for you. Now, in the next sessions, we are going to just practice some of the questions. Let's just look at a summary. So normal loss is not shown in the process account, in the profit and loss account. Scrap income is included in the cost reduction. Abnormal loss is an expense. Abnormal gain is an income, and it is shown in the income statement like this. And for the SOFP, inventory valued at full cost, and abnormal losses and gains do not affect the inventory valuation. So abnormal loss and gain does not affect the inventory valuation because it is coming after their end. And the inventory is valued at full cost because it is lost you have to bear in total for us. So with this, we have completed process account in a very short time, in a very short area. Now, next, what we have to do is we have to practice a lot, and that all that we'll be doing now with some other concepts as well regarding process. There's some connected topics with process accounting, so we'll be doing it in the next session so that we are able to grasp them with a fresh mind. So that's all from my side for today. Hope you guys learned some new things and were able to understand the concept of process accounting. Hope this was beneficial for you guys. See you in the next session. Goodbye.